Hi folks, I'm Bob Benny.
I'm Jesse Thompson.
And we're both certified financial planner professionals with Bob Benny Wealth Management here in Lincoln, Nebraska. Welcome to today's Bobcast. What's today's topic of the Bobcast, Jesse?
Today's topic is, are dividends worth the hype?
So, sometimes people are attracted to dividends and are misled into thinking that dividends
are more valuable than they are.
Yeah. And so all a dividend from a corporation is a distribution of money. It's not necessarily a distribution of profit. In fact, sometimes companies lose money in a year and yet they still pay a dividend. They borrow money even to pay a dividend. And when companies or stocks are categorized as a growth stock or a value stock, basically that has to do with whether they're paying a dividend or not. If a company, when companies make profit, they have one of two choices with the money. They can either hire more people, build more factories, buy more equipment or supplies, that sort of thing, invest the money back in the company, or else they have to pay it out to the shareholders. So a more mature company that isn't growing as much, or they've gotten as big as they want to be, or they don't want to grow so much, what they'll do is they'll start paying out part of their profits as dividends. So that's the difference between when you hear somebody talking about a fund or a stock being a value stock or a growth stock. That's what it is. It has to do with the dividends.
So we're going to talk about some common misconceptions about dividends. So the first one is that just because a company pays a high dividend or pays a dividend means that company has higher returns than a company that doesn't pay a dividend. That's just not true.
Right.
Here's an example of what happens when a company pays out a dividend. So let's just pretend company ABC the stock price is worth $100. And they're a dividend paying company. They're going to pay out a dividend to their shareholders of $5, let's say. The second that they pay that dividend out to the shareholders of $5, their stock is not worth $100 anymore. It's worth $95. So the dividend gets taken out of the value of the company when it's paid out.
It gets taken out of the company's bank account, right? I mean, it reduces the assets of the company by $5 the instant that happens.
So the total value of it is actually your total wealth is unchanged when you get paid a dividend.
Yeah, because you have a $95 stock and $5 in the dividend. You still have $100.
Right. Okay. What's the next misconception?
So the next misconception that we have is that dividends mean a company is turning a profit or that they're good. That's not true. Companies will even pay dividends when they lose money. For instance, there's some older and mature companies that have had a history of dividends and even rising dividends that their shareholders count on. Well, they don't every year make money. They don't every year make the same amount of money. And even in years that they lose money, they'll still pay out that dividend to keep their shareholders happy, even if they have to borrow the money to pay the dividend.
Because a big reason for companies paying dividends is to make their stock more attractive, especially if they're no longer a growth stock where their shareholders aren't seeing their share price continue to grow and go up as steeply as it would have been or as
Right.
other growth stocks are. They say, well, we have to add value to the shareholders, so we're going to pay them out a dividend.
Right.
And so that we can remain attractive and they want to keep our stock.
So what's the third misconception?
So
Yes.
the third one is that using dividends is a more dependable strategy for steady retirement income than just selling stocks to get the monthly income you need. And that's just not true because dividends are not guaranteed. Even companies that pay regular dividends, they don't have to pay those dividends. They can stop paying them whenever they want. They can go down anytime. There's no guarantee. It's no more dependable than just selling a portion of your portfolio to get the monthly income that you need.
And if a company falls on hard times, even a company that's been paying out a dividend regularly for a while, if they fall on significant enough of hard times, they're going to reduce or eliminate that dividend. So the fourth misconception regarding dividends is that using dividends allows you to live off the earnings rather than dip into the principal. And there's just no way to completely guarantee that you won't dip into the principal under either strategy, whether you're selling shares of stock or living off of the dividends. Explain why that is, Jess.
Well, let's pretend that you're just trying to live off the dividends and not dip into the principal. When your company pays a dividend, the company pays a dividend. For one, like we talked about earlier, their stock price goes down by the amount of the dividend. For two, if you're invested in the stock market, when the stock market goes down, or if something happens to one of those companies that you're invested in that's been paying a dividend, the price is going to go down and your account value is going to go down. And there's no way to, even if you're only taking the dividends, there's no way to guarantee that your account won't go down past the amount that you put in at some point.
Right.
Because you're taking the dividend out of it rather than having it reinvested. So you're taking money out of your account. Sometimes you're going to be taking money out of your account while the stock market is going down. And it's just impossible to guarantee that you're not ever going to dip into the principal of your account, even if you're taking it out with dividends. Just the same way as if you're selling a little bit of stock every month in order to get the amount of income that you need monthly, sometimes just that same way, when the market is down, you're taking money out, and sometimes your account's going to dip into the principal. That's just part of investing. Unless you're invested in something that's completely fixed, like the interest rate is completely fixed, you are going to be at risking that. That's just part of it.
Right.
And that's part of the whole risk return thing, where if you want higher returns with when your portfolio has the potential to continue to grow as you're taking money out, you have to take that risk that sometimes you're going to dip into the principal.
That's right. It's not really principal in the case of the stock market. It's an investment, and the investment's doing this. And so when it's like this, you're dipping into the principal. Yeah. It's not really principal.
That's a very common question, I think, that we have, and misconception that people have in retirement.
So the research shows that using dividends for retirement income actually underperforms just using systematic withdrawals and selling shares. It's best to build a diversified portfolio to focus on total return rather than dividends alone. We don't worry about dividends. In fact, I believe, and I tell people, dividends are meaningless. Other than that, a company paying a dividend causes you to have a tax consequence. If they pay a dividend, and whether you're taking the dividend or reinvesting it in more shares, it's a taxable event that you have to pay taxes on. And so dividends aren't necessarily good, but they're not necessarily bad, but sometimes if they're causing you to pay taxes, they are bad. So anyway, thank you for attending our Bobcast today. We appreciate your attention. If you have any questions, you can sure either call the office or email either bob@bobbenny.com or jesse@bobbenny.com. And or if you have any kind of feedback, we just appreciate your attendance and hope you have a blessed day.
Thank you.
Thank you.